Our next guest warns the Fed is putting the U.S. in a danger zone. Peter Boockvar is the Chief Investment Officer at Bleakley Advisory Group, CNBC contributor. Peter, I know you've been listening in on our conversation. So what does that danger zone look from your vantage point?
So I'm okay with the destination of the Fed wanting to take the Fed funds rate to call it 4-ish. The problem I have is the rapid and ferocious velocity at which they are tightening monetary policy. And while they want to talk about the lead and lag variables, and it takes time for this to flow through, I think the speed at which they're hiking is the biggest risk. And I think that we're already beginning to feel the beginning of it. And from the hikes from here, I think that things start to really become precarious and more accidents or have the potential of taking place.
So basically, I mean, just sort of piecing together, you've been on the show many times, on the network many times. The Fed is covering up its mistake with another policy mistake. Two wrongs don't make a right at this point, and it's going to be even worse in terms of the outcome.
Yes, but this is not going to be the first time. I mean, just look at the Greenspan response to the tech bubble. Cutting rates to 1% at the time was unprecedented, and then he left it there and then raised it all the way up to 5.25. That was another. Now that was in a measured pace, but that was a very sharp rise in interest rates on top of a very over-levered housing market. And the economy as a whole, and as I said this before on the show, that it has been very dependent on low interest rates, and economic behavior has been very dependent on low interest rates, and valuations of pretty much everything, whether it's securities or it's paintings or cars, have been predicated on very low interest rates. So just again, the rapidity of this move to me is the biggest risk.
Peter, it's Karen. Thanks for being on. I always love to read your commentary. Do you think, though, that inflation, if let's say we see another similar inflation number to what we just recently saw, what would you advise the Fed to do if we're still pretty hot?
I still think the Fed needs to slow down the rate. They can still continue on with their destination, but the rate of the increases, I think, needs to slow. And a hot inflation number, if it's driven by rents, well, that's looking at the rearview mirror, because rental increases are slowing on a year-over-year basis. So the Fed is going this way with the way that they're viewing the biggest component of the CPI, while in reality it's moderating. So I don't think that they should change their approach here. In terms of the destination, but the pace, for sure, they need to slow.
Hey, Peter BK. So I have a question outside of the inflation rates. Let's say you're right, and I happen to agree with you that the pace that they're raising is probably too much, and it's creating these events like we talked about at the top of the show. But let's say you're right, and it's over tightening. Where is the unemployment rate? I've had discussions with folks that have said, it might be 4.5%. But if you look back in history with inflation at these rates, what Volcker had to do, you had 11% unemployment. So where do you see the inflation rate in this, and then how does that impact the economy?
I think the unemployment rate goes north of 5. I was listening to what you guys were talking about before, and I think the biggest risk to markets is more of an earnings recession rather than an economic recession. And I say that because even if the unemployment rate's still going to rise, I think these labor cost pressures, while maybe they don't accelerate from here, are very much embedded right now at this 4 to 6% range. So I think that there's more downside risk to the earnings story than there is to actual GDP.
That's interesting. Peter, thanks so much for joining us. Always great to get your take. Peter Boockvar of Bleakley, appropriately named for his outlook. Okay, so an earnings recession, that's interesting. So all these sticky parts of inflation will stick, and then there'll be less demand on top of that for the product.
Yeah, and again, we talked about this last night. I think we're going to start seeing that in some of these enterprise companies, results. And I will say this: I think Apple and Microsoft might do Jay Powell a huge favor by actually guiding down. Okay, having investors kind of reset their expectations for, again, those two stocks are for trillion in market cap, and they are really holding up the value of the S&P 500. And I mean that because rather than piecing it out and seeing how things go, maybe set some very cautious expectations, let investors reset. If they really are trying to hit the stock market, they actually now have to focus on a handful of stocks, not just the monolith that is the stock market, because to me, we already went through this. These top 10 stocks have a much higher multiple than the other 490 in the S&P 500, and that's the only way you're going to get investors' attention about the stock market as a whole.
How do you think, BK, about the multiple of the biggest cap tech stocks out there right now relative to the overall market?
I mean, overvalued, I guess, is the simplest thing. But if you, again, you look back, where was the PE ratio at the lows in the 80s, right? It was 7. Now, I'm not necessarily saying we go back there, but even if we're lower from here, let's say we go to a PE of 12, you're talking about much lower prices, particularly if you're going to get rates above 4.5%, 5 or 6%. That's the biggest concern here, is that rates might be doing their own thing and having knock-on effects to the economy, which ultimately, and I agree with Dan, everybody's an index investor now, so you actually have to get the index lower to make people pay attention.